So today's cardinal lesson, the rising tide of boomer care. Will you be carrying the load? And I'm talking to you boomers out there, baby boomers, of which I'm one of, 1946 to 1964. It's significant. And, you know, the leading edge of the baby boomers are turning 80 this year in 2026. And the trailing edge are turning 62 and they're first eligible for Social Security. So this whole cohort is just, we've been racing through all the cycles of life and we're now in the retirement age and we're facing long-term care. So I want to push it to Drew. Drew, why don't you go forward?
Thanks, Hans. Tom, tell us, why are we doing this video today?
Yeah, I mean, we're doing this video because of all the things we do. The most impactful, I believe, is planning for this care, right? I mean, unfortunately, in our world, in our business, we've run into a lot of families who are right in the middle of this crisis, which it is a crisis when someone needs care. And it is the most difficult thing that we have to do to plan around. I can see it on the families' faces, right? The children are stressed out. It's hard. They're taking care of mom and dad. It's just awful, right? And so, what we really want to impart on you is this is important to plan around. We'll go through all the details here, but I just want you to, if you've never thought about this or you've never experienced this, I really want you to sit down, watch this video, and really think about what happens if this were to be me. If I need care, what does this do to my family? Because they are the ones who pick up the pieces, right? They're the ones who bear the burden. It's not you. I went through this, right? If you watched our channel, you know I got sick. You know, there's other videos I go more in detail. Who picked up the pieces was my wife. She was the one taking care of me. Not to say it wasn't hard, but it was harder on her, right? I was worried about just getting better. She was having to manage a household, manage the kids, manage my health appointments. And that's when we're young and healthy, right? Or I guess I wasn't healthy. She's young and healthy. Fast forward, 60 years, it's awful. So if you've never thought about this, I really want you to think through and look into this. So let me bring up the show notes. You can find these at below the video on our our website here. They're also on YouTube. They're also on our website at Cardinal Guide. Today's show notes are pretty light, right? We just have the board, which we'll get into as we walk through the video here. So it's there. Some people print it out. They'll take notes on it. If that's you, great. If not, that's fine as well. But you can find those here. And let me turn it back to Drew, and then we'll go through the rest of the board here.
Hans, looking at the board here, we're seeing a literal tsunami of care needs about to hit the baby boomer generation. And so, how massive or significant is this crisis, and what are some of the milestones that these families will be hitting?
Well, for starters, the 1946 birth, that was the year after the war ended, and the babies started arriving, the baby boomers. They're turning 80 this year. And I can tell you right now, some of the people turning 80 are already getting care. They're already getting long-term care. And by care, I'm really talking about assistance with a daily routine. I'm not really talking about a nurse coming in and doing physical therapy, although that's technically long-term care. What we're talking about is somebody, maybe you, needing help just getting through a daily routine, bathing, dressing, eating, transferring, hanging out, going to the store, living your life, just day-to-day things you take for granted right now. You might possibly need assistance with this. And so what we're talking about is the 1946 births, the leading edge of the baby boomers, are turning 80 this year. The trailing edge are turning 62. That's the time to start planning for this at 62, not 80. But if you haven't done anything by 80, it's still not too late. It really, most of the people that really address this problem through us are in their 60s somewhere, in early 70s. That's when they, and a lot of them are saying it's too late. So let's just talk about the video and give a couple statistics. There's 67 million baby boomers alive today in the US. Okay, and these baby boomers have changed everything as they've passed through the generations. I mean, the 401k was invented in the late 1970s, early 1980s, and that's when we were just starting our career. Some of the older of us were a few years in, but we've amassed pretty big balances, a lot of us, in our IRA 401k money. And that was a new thing. And now we're getting into retirement. Many of us are already in retirement. We're now living off of that money. So what today's video is really about is this whole 67 million, which is like a third of the population of the US, in the 20s somewhere. They're facing long-term care, their family, and it's going to affect their whole family. So a large number of these baby boomers, which could be you, are going to need caregivers. And who's going to care for you? I mean, have you thought about that? Have you planned that out? And when we do financial plans for people, we ask you these questions. And if you have adult children, you have a spouse, I mean, the obvious quick answer is they will. And relying on your adult children to care for you when you need assistance with a daily routine is not, a lot of times, not very practical. I mean, your adult children and your grandchildren have jobs and they have a life, and they're really going to have to shut that down if you're going to need to be cared for around the clock. So where we're going with this whole thing is planning for this. And many people put off planning until the crisis happens. And so we get called in a lot of those cases because a lot of our clients coming to us in their 60s, they have these issues going on with their parents, and their parents may have just thrust into a crisis, and they're going to call us in as financial planners to try to help them with the financial end of the crisis. So we have a lot of experience with this. Drew?
Tom, can you expand on what it looks like to put off the planning until the crisis? What happens when people wait too long to prepare for this?
Yeah, and unfortunately, like Hans mentioned, this is something that we see a lot, right? I mean, it's our clients are coming in, they're typically meeting us in their 60s, sometimes 50s, sometimes 70s, but it's their parents that are the ones oftentimes needing the care. And so we see it happen all the time. And immediately what happens if there's no plan done, the first questions that start asking is all about money. Is how are we going to pay for this? How much does it cost? Where are areas we can sort of save some money on? And it's not about the care. I mean, the care is sort of what's needing the cost. That's what's sort of driving the talk about the money. But that almost always that's where the conversation goes initially, is money. When we have families that have done planning, that have insurance or have a plan in place, because planning doesn't always mean insurance, right? We'll get to that a little bit later in the show here. But assuming they have a plan in place, they already have a funding mechanism for this plan. Now the conversation revolves around, where is mom or dad getting cared? Is it at home? Is it at assisted living? Most people don't want to go to a nursing home. And that's honestly, that's where most people, when we bring up long-term care, their mind immediately goes to a nursing home. Most care planning is done to keep you out of a nursing home, not for a nursing home care. Now, there are situations that nursing home care is needed, but that's sort of the exception to the rule. Now, I will say some people come in and they maybe have heard about, oh, the state will pay me. Medicaid is what will pay for that. Now, quick sort of sidebar here. Medicare is different than Medicaid. Medicare is the health insurance for 65 and older. Medicaid is what pays for nursing homes. And Medicaid in most states will only pay for a nursing home. So a lot of times when you're doing this Medicaid planning, really what you're doing is you're planning to go to a nursing home, which is really where you would last want to go receive care. But that's sort of a sidebar there. Back to your question, Drew, what happens when there is no plan in place? It's a crisis. It's going to be a crisis even if there's a plan. But we go to the money. We figure out how much do we have? Where do we want to pay for it? I will tell you, mom and dad, who are the ones needing care, are going to be unwilling to spend whatever the cost is. I've had family not even tell their parents what the cost is because they know they don't want to pay that. And I'm talking about people who have money, right? Then when they talked about long-term care in their earlier years, oh, I'll just pay for it when it happens. The time comes, they're unwilling to pay the money, right? And that's another benefit of insurance, is we have a funding mechanism in place where they're not having to spend through their assets. So when this happens, it's a crisis. The conversations around money, and then who ends up bearing the burden of a lot of the caregiving, assuming that we're not hiring people because they don't want to spend the money, it's the kids, right? The kids are putting their lives on hold. they're quitting work, they're dialing back their hours, and they're going and spending time with mom or dad, which isn't all bad, right? I mean, they get to spend some time there. But unfortunately, that time is spent doing the heavy lifting, the bathing, the dressing, the getting in and out of bed, not spending time just loving, mom or dad and spending time there. So I don't want to paint it as all bad, but just from experience, when I see clients and I meet with them, say quarterly, they come in, I can just see it draining them, right? I mean, these are the caregivers themselves. It's killing them, right? It's they're stressed out, they're not getting sleep, it's straining relationships that they have with spouses and with their children because they're spending all their time pouring into providing care for mom or dad. And it's just awful. So, I mean, I could go on and on, but I just want to impart sort of experience that I've seen from clients. I've lived it. And I will just, one more point is the people who have provided care, they've lived through this, of giving care for mom or dad. They're the first ones, or they're the last ones that sort of put up any hesitations about planning here because they know they don't want to put their kids what they went through when they were taking care of their mom or dad. So I'll turn it back to Drew.
Hans, can you start enlightening us on what options people have to address long-term care needs using insurance?
Yeah. So we break them into 4 categories, and we run into a lot of people that have already rejected long-term care insurance when perhaps they've only seen one of these things. So, and a lot of times the one they've seen is traditional long-term care insurance. So what I wanted to do in this video is give you a general price range. And this has a lot of latitude in it, but just to give people an idea of the cost of this kind of stuff. And with traditional long-term care insurance, what you're talking about is just paying a premium every month or every year for the rest of your life. And the premium that I've got up here is $500 a month per person, or $6,000 a year. And that's going to buy you a pretty robust long-term care policy in your 60s. In your 50s, it's going to buy you a very robust one, but you're going to have more importance of inflation because you're not going to be using this thing possibly for 20, 30 years. And in your 70s, you can still get long-term care insurance in this price range. The coverage is going to be a little more limited. And so a traditional long-term care policy, the upside to that is the least way. I mean, you pay $500 for the first month and commit to paying the premium. That's probably your least expensive way to get coverage. The downside to it is that the company can raise the premium. And then what people will bring up is if you never use it for long-term care, it's like you've wasted all this money. And that's kind of true with any kind of insurance, is that with traditional long-term care is just like fire insurance, is if you pay fire insurance and homeowners insurance on your home for 30 years and you never have a fire, well, you're going to say, well, I threw away $50,000, $60,000, $70,000 of premiums over the years insuring my home. Well, probably not. You're not going to say that. But with long-term care insurance, people are going to look at that and say, well, if I never use it, I've just wasted all that money. Well, no, you haven't. You've paid into premiums into a pool, so the person that has collected several $100,000 in benefits, and it really indemnified them. So that's traditional long-term care. That's been around for a lot of years, and it's certainly an option that we put with our clients. The second option is hybrid life long-term care insurance. So that is a policy where a lot of people buy these with a single premium, or they spread the premium over the next 10 years. And this costs more than the traditional, but you have equity in this thing. And so if you never use it, your heirs are going to get a life insurance benefit. So it satisfies those people that say, I don't want to pay into this for years, never use it, and then nobody gets anything but the insurance company. Well, in this case, this policy is going to pay out a death benefit, a substantial death benefit to your heirs. Furthermore, if you're chunking a big change, especially paying a single premium, you have equity in this policy that you could go get that money if you wanted to back out of the policy or you needed it for some type of crisis. And then the third category is you've got a hybrid annuity long-term care insurance. And the annuity is used, let me just try to simplify this. It has a lot of similarities to the hybrid life long-term care, but it's easier to qualify for. So people with health conditions that thought that they couldn't get long-term care insurance. They couldn't get number one or number two. A lot of them are able to go. We sell a lot of this to people. And, the amounts that you need to buy a hybrid life long-term care is about $100,000 a person, give or take. So if you're doing it on a couple of $100,000, and with the annuity, it's pretty much a similar premium, although you may want to crank a little bit more to get the benefits up there. And then the fourth category is this thing called short-term care insurance, and it's a 1-year benefit period for both home health care and nursing home care and assisted living care. So, and it's about $150 a month. So this is, and it's a little easier to qualify for than this traditional long-term care. And this is only available in 39 states. I mean, we have several states that haven't approved that fourth category, and we don't have any options available for that. Drew?
Going back to traditional long-term care insurance and touching on that, when you're working with our clients, who do you feel fits into this category of being a good candidate for traditional long-term care?
Yeah, I mean, I think one of the things, once we've sort of done a plan, and a lot of times, or most of the time when we're recommending a long-term care insurance, it's part of a larger financial plan. Because at the end of the day, we can't recommend something to you that's unaffordable or doesn't fit within the larger plan here. So that's a piece to know. Sorry, this isn't just only look at long-term care. We want to look at the full picture. But on the traditional policies, we start with underwriting, right? I mean, some people they've bought into the idea of planning. They want to look at insurance. Unfortunately, sometimes some things are limited just from an underwriting perspective, because for all these policies, there's health questions to get it. Of the 4 on this board here, traditional long-term care is going to be the hardest to qualify for. It has the strictest underwriting. And so there could be a scenario where someone really likes it, but they can't get it because their health prevents them to do it, which is another reason you want to start looking sooner than you might think, right? Because the longer you wait, the more risk you have of something happening that will prevent you from getting it. So underwriting is a big component. It's like, can we get it? So assuming we can get it, now we start looking at okay, is the life insurance component important to you, right? Some people don't really want to spend. All of these are not inexpensive, right? They take some money to purchase all of these. Some people are unwilling to put money aside and with no guarantee they're going to get it back. If that's you, right, if you're really considering like, I don't want to pay for something that I might never get any benefits from, that's where we start looking at the hybrid policies. The traditional policies, on the other hand, are going to be for people who's like, the death benefit's not a huge priority. I really want the most benefits for the least amount of money. Traditional long-term care is absolutely the way to go. Is something that we can build as part of a budget, understanding that it can raise rates, right? These companies can increase premiums, but we'll have that discussion. We build that as part of the plan there. And so for someone who really wants the highest amount of protection for the least amount of money, traditional long-term care is absolutely the way to go to get that.
Hans, options 2 and 3, they're both hybrid. As you said, one is life insurance, the other is an annuity. Tom just alluded to the fact that there's a residual benefit if you don't need care. What is the difference in that regard with hybrid life versus hybrid annuity long-term care policies?
So now we're talking about the death benefit, not talking about the long-term care benefit. And what I'll point out is the long-term care benefit in number 1, number 2, and number 3 are very similar. So in other words, we can structure the policy, whether we're doing number 1, number 2, number 3, like $200 a day, 3% inflation, policy pays for 5 years. I mean, we could make that consistent and have similar benefits in 1, 2, and 3. And so now you've asked me to make a comparison of the death benefit on number 2 and number 3. Okay, and we're just going to assume that they have similar long-term care benefits, which is what you're buying it for. And so the difference between number 2 and number 3 is this one's life insurance, this one's an annuity. So, in other words, if you die without using any of the long-term care benefits, this one is the life insurance benefit is going to pay the most benefit. You're going to get more if you put $100,000 in there years ago and then you die, your beneficiaries are going to get substantial money back, like $130,000, $140,000, $150,000, and they're going to get all of that tax-free. So that's very important. With the annuity, your beneficiaries are going to get less because it doesn't have that life insurance component. What they're going to get is what you put in there initially, and then whatever interest it is earned during the years. So if, in this case, it might be $120,000, $130,000, where 20 to 30,000 is accumulated interest. $100,000 was the initial deposit, and that gets paid out when you die to your beneficiary, having never used it for long-term care. Your beneficiary then is going to have to pay income taxes on that interest that was accumulated in that $20,000 to $30,000 is going to be taxable to the beneficiary, whereas the original $100,000 that you put in won't be taxable to them. Drew?
Hans, looking at the premiums for options 2 and 3, the two hybrid options, does it have to be single premiums for both of those?
It does not. So the hybrid life long-term care insurance, typically when people don't, people just are not willing, or they don't have the $100,000, but they still like this kind of insurance. Well, they can spread that out. The typical spread out is 10 years. So that might be $12,000 of premium per year for 10 years, or a total of $120,000 might be the same as putting $100,000 up front. So you can spread that over 10 years and get very similar benefits. Some of those policies, you can stretch it out for 20 years or to 90 or 95. So you could have basically a continuous premium for the rest of your life, or almost the rest of your life. So there's a lot more flexibility with this. And then the premiums start to similar. They're going to be more, but they start to get, and this policy starts to resemble traditional long-term care, where you're paying for it for the rest of your life. But you asked me to compare number 2 and number 3. With the annuity, you can't do that. I mean, you typically have got to put in all the money up front. Okay. Now, we do have one company that we do these annuity long-term cares that'll let you put $50,000 in the first year, and then they're going to give you 5 years to add in more money at your will, without any additional underwriting. So they do have a little flexibility, but for the purposes of understanding, this one has to be paid for up front. That one can be spread over time, but it's going to cost you because there's an interest factor in it.
Makes sense. Tom, for short-term care, option number 4, we can see that it's less coverage, but can you expand on how that's broken down exactly? What does that mean in terms of what it offers and what it does for people who buy short-term care insurance?
Yeah, so there's several companies that offer these short-term care ones, but I'll give you a pretty typical structure of a policy is they'll provide 1 year of benefits for home health care and 1 year of benefits for nursing home or facility care. If you had to go to assisted living, that would count on the facility benefit. And so if you timed it perfectly, which, there's no way to know if you would do this, you could get potentially 2 years of care there. Now, that's not 2 years of home health care and then 2 years of facility. It's one at each place. So it's more limited in benefits from that standpoint. The maximum it's going to pay is sort of 2 years consecutively, again, if you time that perfectly. But what's nice about this is it's of the 4 up here, maybe similar to number 3, is more limited underwriting, right? Is people can qualify for these who maybe can't qualify for the other ones, right? So that's something that at least they can get. It's much less expensive, right? If we compare number 4 to number 1, which has the ongoing premiums, we're talking about $150 a month versus $500 a month. Now you are getting less benefits, right? So you get what you pay for. But for some people who really are wanting to plan for this, they don't have the budget for some of these ones, but still want some meaningful benefit. A year or 2 years is still a long time of care that really gives your family a chance to sort of figure out what we're doing, right? Are we selling the home? Are we doing a reverse mortgage? Are they moving in with one of the children, right? It gives them time to figure that out, where instead of just being thrown right into the middle of crisis with having no buffer and scrambling to figure something out, we have a lot of wealthy clients that could afford 1 through 3 that end up buying number 4 just to have some benefits in place, right? Just to sort of bridge that gap. It removes some of the risk of market timing, right? I mean, the stock market is not going to cooperate when you need care, right? When you need care, the care is needed right now, regardless of what the stock market's doing, whether it's up or down. And for our wealthy clients who have a lot of their money invested in the stock market, you don't want to sell at a low point, right? You don't want to have to start selling investments right when you need care. The short-term care policy is a way to sort of ensure against some of that risk, some of a timing risk standpoint, and still provide very meaningful benefits. And so it's not a bad policy by any means. We sell a lot of it. Again, like Hans mentioned, it's not available in every state, so sometimes that's some limitations there. But other than that, it's a very useful policy. We do a lot with it, and for people who maybe have more limited means, it's still a way to get coverage without having to spend as much money as some of these other options. Drew?
Lastly, Hans, when clients call us or meet with us via Zoom, what are some of the initial intake questions? What information on the forefront is helpful for us to start figuring out which of these options works best?
Well, I mean, one of the things that comes up immediately when somebody's coming in to do financial planning, or even if they're just inquiring about long-term care, we need to do some financial planning. We need to find where your money's located and what tax effect it has. So how much do you have in your IRA, 401k? Between, if it's a couple, how much does he have? How much does she have? And how much of that is pre-tax and how much of that is already Roth? So we're going to need to get a picture of your money. And then how much do you have in regular savings? So we're going to figure out, and then what's your income? So before we even get into recommending one of these categories of, or putting forth a policy, we got to figure out how you're going to pay for it. That's what you're doing. You know, we're financial planners, and that's what we do. And you know what I reason I mentioned IRA first is our biggest seller of long-term care insurance is this number 2 category, a life long-term care policy purchased with IRA money. And what people do is they transfer their IRA money or some of it from where it is to an IRA at the insurance company. And then from that IRA at the insurance company, that pays the premium on the life long-term care policy over 10 years. So it's a little complicated. We have other videos on it, but we're going to need to know where your money's located and first qualify you for that kind of a policy. And this stuff is actually purchased better with non-qualified money or not IRA money. So if you've got a significant amount of that, tax-wise, it works out better to buy this thing with non-qualified money. Then we need to know about your health, and we need to know whether you have any chronic illnesses and how long you've had them. And this is where we get into the underwriting component. Is we don't want to work this all out financially and find out you can't answer the health questions and you can't qualify for it. And that's where a lot of people that are looking at this first end up buying this, because we have people that have qualified for this that have Parkinson's. I mean, it's maybe hard to believe, with rheumatoid arthritis. We have people with MS, and it's not active right now. I mean, that are able to get this type of thing. So we're going to need to have a health history, and we're going to need to have financials or some form thereof.
Thank you. Anything you want to add to that, Tom?
Yeah, I mean, I think one of the things that I just want to go back to one of my earlier comments here is this is an important piece of the overall plan. Unfortunately, one of the biggest sort of roadblocks, if you will, for having this discussion is denial, right? Is this not going to happen to me? I'm not going to be the one who needs care, and that's someone else's problem, which I hope is true, right? I hope this doesn't happen to anybody. But unfortunately, that's just not reality, right? There's going to be a large portion of this baby boomer population that are going to need care. And do you want to be leaving your family in a position where they're struggling and they're thrown into a crisis, they're putting their lives on hold to figure this out? Or do you want to have a plan in place and really, set them up in a way that it's still going to be hard for them, right? I don't want to say this solves all the problems, insurance solves all the problems, but it certainly is a way that we can point to, this is how we're paying this bill. We've already done this planning. We'll figure out where mom and dad are getting cared for, and then we go from there. And so I think it's important to think about, if insurance isn't the route you want to go, I still think having a written plan around the care is important. Like, okay, if this happens to me, because we know it might, then here's the account I want to use for care first, then this account, then this account. I mean, having some sort of roadmap for whoever the one providing the care is going to be, or managing the care, at least knows what to do. Because unfortunately, a lot of times parents don't really talk to their kids about the money they have. So the kids don't even know what they have to deal with. There is no roadmap of how to spend for this. And then it just, it's thrown into just chaos. And so planning for this is important. Insurance, I think, is a great way to do the funding of it. And I think for the people who say, like, oh, I have enough, I'll pay for it. And I could go through example after example after example of clients that we have that objectively have plenty of money. They could absolutely pay the bill if they want to, are the first ones to kick the home healthcare people out because they don't want to pay that bill. They don't want to spend the money. And it all comes back to denial, right? They're paying a bill that feels expensive to them, because it is, on something that they don't really think they need care for, again, which is typically not the case, right? They're getting care because they need it, but they don't want to have need it. So there's a lot of denial that goes into this. And I think really sitting down and having these hard conversations now while you're healthy and can think through all these issues sets up your kids and your family in a better position if this were to happen to you guys. So I'll turn it back to Hans here, and we'll sort of finish up, and then we'll.
Yeah, within comprehensive financial planning, we've gone over really all 7 boxes today. I mean, Social Security, that's the first check that goes to the nursing home directly for a single person. I mean, and it's not going to be enough to pay the whole bill. Medicare, I mean, we do a lot of Medicare planning in all our financial plans, and where that comes in, Medicare, for the most part, doesn't pay for long-term care. So don't rely on it. This whole video has been about long-term care. IRA 401k, that's where people go to pay the bill, the nursing home bill. Yeah, and it just, there's a tax consequence of robbing your 401k in globs. I mean, that's the first place to go. So we need to plan the distributions of that and plan the tax. Income, this is where we're really talking about, is a sudden need for an additional $100,000 a year after taxes to pay a long-term care bill. Big effect on income. Estate planning, I mean, estate planning is, that's what we're talking about here, is people are talking about using a significant portion of their estate after taxes to pay a nursing or long-term care bill. There's all types of ramifications of estate planning. And taxes, just in a financial plan, it's taxes play a big part in long-term care planning. So with that being said, I'm Hans Scheil.
And I'm Tom Griffith.
And I'm Drew Sumallo.
And we thank you very much for listening.
Thank you.
Thanks.